Equity Market Outlook June 2023. Indian markets staged a strong recovery last month, as markets digested full-year earnings and sentiments turned favorable. S&P BSE Sensex and Nifty 50 ended the month up 2.5% each. Nifty Mid-Cap 100 and Nifty Small Cap 100 outperformed their large-cap peers, up 6.3% and 5.6% respectively. India has now closed the gap on its entire YTD underperformance to end. Market breadth remains sturdy while volatility declined further to multi-year lows. India retains its tag as the fastest growing large economy with a GDP growth print of 7.2% for financial year 2022-23. The key drivers for growth have been the strong supply-side pickup across sectors and a roaring investment-led demand. A culmination of these two factors counteracted a weak external market. The inward-looking nature of our economy has thrived as an otherwise gloomy global economy, furthering investor confidence across the global fraternity, making India a preferred investment decision. This is also reflected in the FPI and FDI numbers YTD. Earnings season was seen as largely in line with cyclical sectors like banking, industrials and auto, delivering numbers in line with market estimates. IT as a sector has lagged consensus estimates, hampered by the weakening global environments and client pressures. The markets have been quick to digest earnings. Companies that have failed to live up to expectations have seen share prices reprice, eliminating any premia, froth in trading valuations. Markets have reignited animal spirits after a strong earnings quarter and better than expected macroeconomic data. Our portfolios have tactfully navigated tough investing conditions and have now begun seeing a healthy risk-reward payoff. This is also reflected in near-term outperformance across equity and hybrid funds. Our portfolios today approach markets using a multi-cap approach, mixing large-cap stable growth low-debt companies and mid- and small-cap high-growth niche businesses. The healthy breadth of the market requires larger, more diversified portfolios to deliver alpha, which is reflected in our granular portfolios. In our view, a confluence of cyclical and a structural tailwind are driving the recovery. Cyclically stronger balance sheets, improving macro stability, which reduces pressure on policymakers to tighten policy stance, and structural policy reforms are the keys to sustainable growth. Incrementally, we believe growth is likely in pockets rather than across the board, and active investing in growth and quality will be key to alpha creation. Corporate earnings of our portfolio companies continue to give us confidence in the strength of our portfolio companies. The markets have kept quality away from the limelight for over 18 months, making valuations of these companies relatively cheap both from a historical context and a relative market context. We are optimistic about a recovery in consumption demand in the next 2 to 4 quarters, as incomes recover in rural areas and affordability improves from the twin positives of higher household incomes and stable inflation. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.